You bought a home. It might be the biggest financial decision you've ever made. You saved the down payment. You got approved. You signed more documents than you've ever signed in your life. And when it was done, you held a set of keys and a belief that from this month forward, every payment you make is building something. Equity, ownership, wealth, a future you can stand on. That belief is not entirely wrong, but it is not nearly as true as you think it is. And the distance between what you believe is happening with your mortgage payment and what is actually happening is the most expensive gap in American homeownership. Let me show you what your payment is actually doing right now, because nobody showed you this on closing day. Take a $300,000 mortgage at 7% interest, a standard 30-year fixed. Your monthly payment is roughly $2,000. Every month, without fail, $2,000 leaves your account and goes to the bank. You see the payment. You feel it. You believe you're buying your house. In the first month, here is where that $2,000 goes. $1,750 goes to interest. $250 goes to principal. That's it. 87 cents of every dollar you pay in the first year goes to the bank as profit. 13 cents goes toward actually owning your home. You probably didn't know that. Most people don't. It wasn't in the brochure. It wasn't in the conversation with the loan officer who congratulated you. It was in a document called the amortization schedule, a table buried in your closing packet that shows exactly how every payment breaks down, month by month, for 30 years. You signed it. You almost certainly didn't read it. Nobody told you it was the most important page in the stack. Now, 87% to interest in the first year might feel like a temporary imbalance, something that corrects itself quickly. It doesn't. After 5 years of payments, 60 months, roughly $120,000 sent to the bank, you have reduced your principal by approximately $15,000. You paid $120,000. You own $15,000 more of your home. The other $105,000 went to interest. It's gone. It built nothing. It sits in the bank's balance sheet, not yours. After 10 years, this is the number that should keep every homeowner awake. You will have paid approximately $240,000. Your principal will have dropped by about $40,000. $200,000 in interest, paid by you. Over a decade, while you believed you were building equity. And here is where this becomes personal in a way nobody prepares you for. The average American sells their home within 7 to 10 years of buying it. Job change, divorce, growing family, downsizing, relocation. Life happens. And when you sell at year 7 or year 8, you discover something the amortization schedule always knew. You barely own more of the house than you did the day you moved in. The equity you thought you were building month after month was mostly interest flowing out of your account. The wealth you thought was accumulating was mostly traveling in one direction, toward the lender. Quietly, steadily, for years. You sell the house. You pay the real estate commission. You pay closing costs. You subtract what you still owe on the mortgage. And the number left over, the number that's supposed to represent 7 or 8 years of $2,000 monthly payments year after year, is shockingly small. In some cases, after all transaction costs, it is close to nothing. You didn't build wealth. You rented money from a bank at a premium and called it homeownership. Now, why is it structured this way? You might think this is just how math works. Interest is calculated on the remaining balance. The balance is highest at the beginning. So of course, more interest is paid early on. That's technically true. But consider who designed the 30-year mortgage and why. The 30-year mortgage didn't become the American standard by accident. It became standard because it maximizes the total interest the lender collects. A 15-year mortgage on the same $300,000 at the same rate charges you roughly half the total interest. Half. But the monthly payment is higher, and a higher monthly payment means fewer people qualify. So the 30-year term became the product the industry promotes, not because it's the best deal for you, because it's the most profitable structure for the lender, wrapped in a monthly payment low enough that you say yes. And the amortization schedule, the one that shows 87 cents of every dollar going to interest, is not presented to you as a warning. It is presented as paperwork. One more document in a stack of 60, initialed, signed, filed, forgotten. You didn't ignore it out of carelessness. You ignored it because the closing process was designed to move you past it. Think about what it would mean if, on closing day, someone sat you down, before the celebration, before the keys, before the photos, and said, for the first 10 years, roughly 80% of every payment you make will go to interest, not principal. After a decade of payments totaling $240,000, you will have reduced your loan by $40,000. If you sell before year 10, your equity may be negligible after transaction costs. Would you still have signed? Probably. Homeownership carries value beyond the math, but you would have signed with different expectations, and different expectations would have changed how you managed that mortgage from the very first month. Because here is what nobody tells you. You are not locked into the amortization schedule. You can break it. And breaking it is simpler than you think. One extra mortgage payment per year, just one, on a $300,000 loan at 7%, saves you approximately $85,000 in total interest and eliminates roughly 7 years from the loan. One payment, not a refinance, not a financial product. One additional payment per year reroutes $85,000 from the bank's column to yours. And the reason this works so dramatically is the same force that makes the early years so expensive: front-loaded interest. Every extra dollar you pay in the first decade goes directly to principal, which reduces the base that interest is calculated on. It breaks the waterfall at its source. You don't need to double your payment. You don't need to refinance into a 15-year unless you can afford it. You just need to understand that the amortization schedule is not a fixed sentence. It is a starting position. And every dollar you send above the minimum, especially in the first 10 years, rewrites the math in your favor. Even rounding up your payment by $100 a month changes the trajectory. Even switching to bi-weekly payments, which produces one extra full payment per year, shifts tens of thousands from the bank's column to yours over the life of the loan. You can run this yourself. Any mortgage calculator online will show you exactly what one extra payment per year does to your specific loan. The number it shows you will be the amount of money you are currently scheduled to hand to your bank in interest, that you no longer have to. You signed those documents believing every payment was building your future. 87 cents of every dollar was building someone else's. That was always in the paperwork. It was always on that page. It was always the math. Now you've seen it. And a mortgage you understand is a fundamentally different instrument than one you don't.